Hi, this is Roger Nussbaum. Welcome to The Big Picture for the week of December 10th. Got a couple of things on the agenda this week. First is To the Blogger Goes the Spoils. Second, a little talk about BEP. And then lastly, what I would want to see in the way of ETFs. First, from the humor department and To the Blogger Goes the Spoils, the folks at Ridex sent me a big thing of these brownies, and my wife said she might even let me eat one or two of them. Okay, moving on to BEP. BEP is actually the ticker symbol, BEP, for the S&P 500 Covered Call Fund. It's a closed-end fund. It's not an ETF. It's been around for a while. I'm pretty sure I've touched on it a couple of times in the past on the blog. It had kind of a weird start when it first started trading. It kind of fell out of bed, traded at a big discount, as you might expect. And since then, the market price has moved around quite a bit. Last April, it traded at an 8% discount. Recently, it's moved up to trade from an 8% discount to a 3% premium to NAV, and actually 3.5% premium. According to ETF Connect, it has over a 10% yield. I'm assuming that there's leverage in there. I haven't looked to check, but it's kind of an interesting thing. What brought this to my attention was Adam Warner over on the Daily Options Report had a post about the fund trying to warn that it's not the be-all, end-all, which I agree with. The idea has, as I've said before, very limited weight. I use an actively managed closed-end fund, but it's the same difference, limited exposure. But what's interesting is now that the initial pricing is out of the way, that fall off of a cliff that happens with most closed-end funds when they first start trading is behind it. The net asset value, if you look at a chart, you can do this on Yahoo, and Adam also was able to get this to work on stockcharts.com. If you compare the net asset value ticker symbol, which is the letter X, BEPX, compare that to the BXM index, you'll see that the correlation is almost perfect, which is kind of interesting. So the flaw in the concept is that you have no way of knowing what the market price might do in and around what the NAV is doing, but it looks like now that the kind of got the it's up and running, it looks like that the NAV is correlating and tracking closely and kind of doing what it's supposed to do. So it might be worth revisiting as a holding. Okay, had quite a bit of chatter this week, obviously, about taking input from readers from a couple of different places about what they'd like to see in the way of new exchange-traded funds. I went to that Dog and Pony show down in Phoenix, which was pretty cool, and I thought I would talk a little bit about what I'd like to see in the way of new ETFs. And from here, I'm going to say that simple is better as far as where I view all of this. Now we're going to see clearly more and more complex things. The macro shares are a good example of that. The concept is interesting. I'm not saying it's not, but whatever it is, and however great or horrible it turns out to be, the word simple is never going to be used with these things. I would like to see very simple, like a timber ETF or a soft commodity ETF. There's a couple out there that blend together various agriculture or soft stuff with gold or energy stuff. I'd like to see just kind of a standalone soft commodity product. I wrote quite a bit about some of the bond ETFs. This to me seems like a no-brainer. That creating, first of all, they'd be easy to create something that I know I would use in client accounts. Again, this is access to foreign sovereign debt through exchange-traded funds. It's essentially impossible. There are actively managed funds, but obviously you don't know what the manager is going to do in the future. And the idea of being able to narrow down and isolate a particular country, I think is very compelling, and for whatever it's worth, I'm convinced it's going to happen. If you go over to indexuniverse.com and you look at Matt Haugen's, who I met at the conference, by the way, if you look at Matt Haugen's article, his recap of the Super Bowl of indexing, he touches on the same thing. Part of all of this simple thing, actually, before I move on to that, let me say, also the Macquarie products. I think those kind of mundane, high-yielding type of products, I'd like to see more of those too, quite frankly. Being able to access those concepts like toll roads, parking lots, and so forth, being able to capture those in different parts of the world, to me is pretty compelling. Here again, you're building in a counter strategy toward bad things happening with the dollar without necessarily taking on real stock market exposure and real stock market risk. The idea behind this, and this is something that Burton Malkiel said at the Super Bowl of indexing, he thinks that yields are going to come down. To quote him, and I mentioned this in the thing, yields are going to be less than what they've always been at 10.5% on the Ibbotson charts. I can't vouch for 10%, but I'll take Dr. Malkiel's word for it and say that if he's right, the implication there should be, in the context of a certain number of years that are up a lot and a certain number that are down a lot or down a little, that if he's going to be right, I take that to mean that there's going to be more down a little years mixed in, and to maybe bring the average down 2 or 3 percentage points. So this would be far from disastrous, just kind of means we need to set expectations a little differently. And having more choice and more themes and more access to different parts of the world in things that are low beta, high yielding, longtime reader George called me the great beta reducer. There's probably a play on words in there somewhere, isn't there? Well, I don't know if that's true or not. Certainly the concept should be appealing. This is a recurring theme here. Should be appealing, something I'm going to continue to write about, and if Malkiel is right, going to become much more important than it is now. And, this is important for you to learn about now, because clearly this year with the market up 12 or 13%, it's far less important than it might be in the future. So this is a great time where you've got nothing on the hook to learn about it. Hopefully there'll be stuff to learn about, and if so, I'll bring it here to the blog. All right, that's about it. Have a good weekend.